Welcome and thank you for standing by. At this time, all participants are in a listen-only mode. During our Q&A session, you may enter your question on the WebEx. This call is being recorded. If you have any objections, you may disconnect at this time. Now I'd like to turn the meeting over to Mr. Ben Bosco, so you may begin.
Good afternoon, everyone, and thank you for joining us for today's teleconference and webinar. I am Ben Bosco of the Federal Deposit Insurance Corporation, and over the course of the next hour, I, along with Ben Pegg of the Office of the Comptroller of the Currency, Matt McQueenie of the Federal Reserve Board, and staff of the federal banking agencies will provide an overview of the recently released Capital Simplifications Notice of Proposed Rulemaking and also answer questions. Today's presentation and a recording of this teleconference will subsequently be made available. Now let's turn to slide 2. It may be helpful to provide some context for the Simplifications NPR. The current capital rule, adopted in 2013, sought to address weaknesses that became apparent during the financial crisis. Since then, banking organizations have raised concerns regarding the regulatory burden and complexity associated with the capital rule. In particular, during the recent Economic Growth and Regulatory Paperwork Reduction Act of 1996, or AGRIPRA, review, the agencies received numerous comments, including oral and written comments submitted by panelists and the public at outreach meetings, requesting that the agencies simplify certain aspects of the capital rule for community banks. Following a careful and thorough review of these comments, the agencies identified several specific items in the capital rule that have caused significant burden to the industry and stated in the 2017 AGRIPA report to Congress that the agencies would seek simplification for these items through a notice and comment rulemaking. On September 27, 2017, the federal banking agencies issued a proposed rule for comment for the purpose of simplifying certain requirements in the agency's regulatory capital rule, consistent with statements made in the AGRIPA report. The proposed rule will have a comment period that closes 60 days after publication in the Federal Register. This teleconference is intended to help interested parties better understand the outstanding proposed rulemaking. Thus, the federal banking agencies welcome any questions today to help clarify the contents of the proposal. Comments relating to the substance of the proposal that are received by the federal banking agencies during the call will be incorporated into the rulemaking record so that they can be properly considered and addressed as part of the rulemaking process. The federal banking agencies encourage interested parties to also submit any comments on the proposal to the agency's respective public dockets. During today's call, please submit your questions to rac@fdic.gov. That's RAC@fdic.gov. Now please turn to slide 3. The proposed rule would address the following items that the agencies identified through the AGRIPA process as causing compliance burden to the industry, and particularly for community banking organizations. The proposed rule would replace the high volatility commercial real estate, or HVCRE, exposure category in the agency's standardized approach capital framework with a revised exposure category called high volatility acquisition, development, or construction, or HVADC. The proposed rule would also simplify the threshold deduction treatment for mortgage servicing assets, or MSAs, temporary difference deferred tax assets not realizable through carryback, or temporary difference DTAs, and investments in the capital of unconsolidated financial institutions. In addition, The proposal would simplify the limitations on minority interest includable in regulatory capital. Ben Pegg from the OCC will now provide further detail on the HVADC proposal.
Hello, everyone. This is Ben from the OCC, and I would like to call your attention to slide 4 of the presentation. On slide 4, we have a visual depiction of the proposed HVADC exposure category, which under the proposal would replace the HVCRE exposure category in the standardized approach. A HVADC exposure would be defined as a credit facility that primarily finances or refinances the acquisition of vacant or developed land, the development of land to prepare to erect new structures, including but not limited to the laying of sewers or water pipes and demolishing existing structures, or the construction of buildings or dwellings or other improvements, including additions or alterations to existing structures. HVADC exposures would receive a 130% risk weight unless they qualify for certain exemptions. Under the proposal, those loans qualifying for certain exemptions would be eligible to receive a 100% risk weight. The proposed exemptions include acquisition, development, or construction, or ADC loans, which finance community development projects, the purchase or development of agricultural land, and 1 to 4 family residential properties. Permanent loans would also be exempt. The proposal would grandfather the current HVCRE treatment for loans originated before the effective date of any final rule. The proposed HVADC exposure definition would include only those ADC exposures originated on or after the effective date of any final rule. Therefore, all ADC loans made prior to the effective date of any final rule would continue to be risk-weighted at 100% or 150% according to the current HVCRE exposure definition. Only ADC loans made on or after the effective date of any final rule would receive a 130% risk weight under the new HVADC exposure definition, unless the loan qualifies for an exemption. The HVADC exemptions include a definition of permanent loan to help banks identify the type of permanent financing that would not be considered an HVADC exposure. The proposed HVADC exposure definition does not include a contributed capital exemption for loans with 15% or more borrower contributed capital. As a result, the restriction on the release of internally generated capital from the project that was part of the contributed capital exemption would be eliminated under the HVADC exposure definition. Additionally, in the preamble to the proposal, the agencies also included language to help clarify the scope of the exemption for the acquisition, construction, or development of 1 to 4 family residential properties. Please turn to slide 5. As mentioned previously, the definition for an HVCRE exposure in the current standardized approach would be replaced with the HVADC exposure definition. Similar to the current HVCRE exposure definition, the proposed HVADC definition is purpose-based. A key clarification in the proposal specifies that an exposure would be classified as an HVADC exposure only if the lending facility primarily finances ADC activities, meaning that more than 50% of the funds will be used for ADC activities. In order to make the determination, a banking organization would review the proposed use of funds, and if more than 50% are intended for ADC activities, then the facility would meet the primarily finances requirement and would fall within the scope of the HVADC exposure definition, unless one or more of the exemption criteria are met. If the exposure is determined to fall within the scope of HVADC and is ineligible for any of the specified exemptions, it would be assigned a 130% risk weight as compared to 150% risk weight that is assigned to HVADC exposures under the current capital rule. The HVADC definition maintains several exemptions that currently apply to certain ADC exposures, which would continue to receive 100% risk weight. Those include exemptions for 1 to 4 family residential properties, loans for community development purposes, and loans for agricultural land. Now on slide 6, we summarize and highlight key clarifications made in the proposal and provide some specific examples of types of exposures that would or would not be classified as HVADC exposures. The proposed HVADC exposure definition specifies the term primarily finances requires that more than 50% of the loan proceeds finance ADC activities. In situations where more than 50% of the loan proceeds finance non-ADC activities, the exposure would not be an HVADC exposure. The preamble to the proposal clarifies the scope of the 1 to 4 family residential properties exemption. For purposes of both HVADC and HVCRE exposures, the financing of 1 to 4 family residential properties includes both loans to construct 1 to 4 family residential structures and loans that combine the land acquisition, development, or construction of 1 to 4 family structures, either with or without a sales contract, including lot development loans. The preamble also clarifies that generally a loan that finances the ADC of condominiums and cooperatives does not qualify for the 1 to 4 family residential properties exemption, except in instances where the project contains fewer than 5 individual dwelling units. Thus, condominiums, cooperatives, and apartment buildings would generally be treated as multifamily properties. If each unit in a project is separated from other units by a dividing wall that extends from ground to roof, such as a townhouse, then each unit would be considered a single-family residential property and thus exempt. Further, the financing of ADC of multiple residential properties, each containing a 1 to 4 family dwelling unit, qualifies for this exemption. Loans used solely to acquire undeveloped land do not, however, qualify for the 1 to 4 family residential property exemption. Under the exemption for community development loans, real property projects that have the primary purpose of community development would not be HVADC exposures. In addition, loans to finance activities that promote economic development by financing businesses or farms that meet the size eligibility standards of SBA's development company or small business investment company programs or have gross annual revenues of $1 million or less also would not be considered HVADC exposures as long as they meet the applicable community development purpose test. Another key clarification within the proposal is for permanent loans. A prudently underwritten loan that has a clear, identified, and ongoing source of repayment sufficient to service amortizing principal and interest payments aside from the sale of the property qualifies as a permanent loan. These types of loans would not be scoped into the HVADC exposure definition. However, bridge loans are generally not considered to be permanent loans and therefore could be HVADC exposures. In another example, if a bank finances an owner-occupied ADC project, the borrower may have sufficient capacity at origination of the loan to repay the loan from its ongoing operations not related to the resale or rental of the particular ADC project. In this case, the exposure could be considered a permanent loan and not an HVADC exposure. However, under the proposal, a loan that finances the stabilization period of an income-producing property, such as an apartment building, or a loan that finances the sellout period of a for-sale project, such as a condominium property, would not be considered a permanent loan. Finally, we look at interest-only loans, which could be considered permanent loans under the proposal if the bank identifies a source of repayment that is sufficient to service an amortizing payment. However, the permanent loan carve-out does not require that the current loan payments be amortizing. Therefore, an interest-only loan may or may not be considered an HVADC exposure depending on the source of repayment. With that, we conclude our discussion on HVADC. Matt from the Federal Reserve Board will now discuss the proposed treatment of certain threshold deduction and minority interest.
Thanks, Ben. We will now move on to slide 7 of the presentation. For banking organizations that are not subject to the capital rules advanced approaches, the proposal would revise the treatment of exposures subject to common equity Tier 1 capital threshold deductions under the capital rule, including mortgage servicing assets, or MSAs, temporary difference deferred tax assets, or temporary difference DTAs, and significant investments in the capital of unconsolidated financial institutions in the form of common stock. In contrast to the existing capital rule, which limits the inclusion of MSAs, temporary difference DTAs, and significant investments in the capital of unconsolidated financial institutions in the form of common stock to 10% of common equity Tier 1 capital with a combined 15% limitation, the proposal would raise the limit for MSAs and temporary difference DTAs individually to 25% of common equity Tier 1 capital and would not include a combined limit. The proposal does not change the definition of MSAs or temporary difference DTAs. We will discuss the new treatment for all investments in capital of consolidated financial institutions when we discuss the next slide. As shown in the graphic on this slide, the proposal would increase the limit on MSAs to 25% of common equity Tier 1 capital. Any amount of MSAs held by a banking organization that exceeds this limit would be deducted from regulatory capital. MSAs not deducted from regulatory capital would be assigned a 250% risk weight. The proposal would also increase the limit on temporary difference DTAs not realizable through carryback to 25% of common equity Tier 1 capital. Any amount exceeding this limit would be deducted from regulatory capital, and the amount not deducted from regulatory capital would be assigned a 250% risk weight. Please turn to slide 8. The proposal would remove the distinction between significant and non-significant investments in the capital of unconsolidated financial institutions, and the deduction limit on all investments in the capital of unconsolidated financial institutions would be 25% of common equity Tier 1 capital. Any amount of these investments exceeding the 25% limitation would be deducted from regulatory capital, and the amount of these investments not deducted from regulatory capital would be risk-weighted according to the relevant treatment for the exposure category of the investment. The proposal maintains the current rule's 100% risk weight for equity exposures up to 10% in total capital, and also maintains the current high risk weights for equity exposures in excess of 10% of total capital. The proposal removes the 250% risk weight for significant investments in the capital of unconsolidated financial institutions in the form of common stock that is prescribed in the current rule. Moving on to slide 9, we will discuss changes the proposal makes to the limitations on minority interest, which is regulatory capital issued by a consolidated subsidiary and held by third parties. The proposal would eliminate the existing complex calculation to determine the amount of minority interest that could be included in the regulatory capital of a parent banking organization. Instead of basing the limitation on the minimum required capital of its subsidiaries, a parent banking organization would be allowed to include common equity Tier 1 minority interest, Tier 1 minority interest, and total capital minority interest up to 10% of the banking organization's common equity Tier 1, and total capital elements, which will be measured before the inclusion of any minority interest and after certain deductions and adjustments. That concludes our discussion on the threshold deductions and minority interest. Ben from the FDIC will now take us through the remaining portion of the presentation.
Thanks, Matt. On slide 10, we describe a separate rulemaking known as the Transitions NPR that was issued in August 2017 in anticipation of this AGRIPA simplification proposal. In the Transitions NPR, the banking agencies propose to extend the current capital rules transition provisions for MSAs, temporary difference DTAs, investments in the capital of unconsolidated financial institutions, and certain minority interest requirements. The Transitions NPR is intended to prevent a situation whereby non-advanced approaches banking organizations would fully phase in certain requirements in the current capital rule that may be changed due to the Simplifications NPR. The comment period for the Transitions NPR closed on September 25th, and the agencies are currently reviewing comments received. Now let's turn to slide 11. Let me first start by saying that the agencies would like to thank everyone for their participation today. The agencies also encourage all interested parties to submit comments on the modifications to the capital rule proposed in this NPR, as well as broad comment on other potential simplifications to the capital rule. Finally, as you can see on slide 12, the agencies have compiled a summary of the proposal for community banks, which is available on each agency's respective websites. That summary document is intended to provide community banks with a brief description of the most significant changes contained in the proposal and does not provide complete coverage of the notice of proposed rulemaking. Community banks are encouraged to review the proposed changes in their entirety. Any questions after the call ends regarding this presentation or the proposed rule may be emailed to regulatorycapital@fdic.gov for FDIC supervised banks, capitalpolicy@occ.tres.gov for OCC supervised banks, or questions at askthefed.org for Federal Reserve supervised banks. This concludes our prepared presentation. We will now answer questions received prior to this call, as well as questions emailed to rac@fdic.gov during the presentation. That's RAC@fdic.gov. Now we'll start with some of the questions that we had previously received. One of the first questions that we received says, how are multi-purpose loans that finance both the purchase of equipment and acquisition, development, or construction activities treated under the proposed HVADC exposure definition? What amount of the loan should be risk-weighted as HVADC? For purposes of the proposed HVADC exposure definition, an exposure will be classified as an HVADC exposure only if the lending facility primarily finances acquisition, development, or construction activities, meaning that more than 50% of the funds or the loan proceeds will be used for acquisition, development, or construction activities. In order to make this determination, a banking organization would review the proposed use of the funds, and if more than 50% of the funds are intended for ADC activities, then the facility would meet the primarily finances requirement and would fall within the scope of the HVADC exposure definition unless one or more of the exemption criteria are met. Therefore, if a loan meets the primarily finances requirement, then the entire loan is considered HVADC and must be risk-weighted at 130% unless it qualifies for an exemption. Additionally, the agencies expect every acquisition, development, or construction transaction to be supported by documentation tailored to the specific project and consistent with prudent underwriting practices. Another question that we received also on HVADC is that, do loans for lot or tract development, including lot or tract development loans for townhouse, condominium, and cooperative construction projects, qualify for the 1 to 4 family residential properties exemption from HVCRE and/or HVADC exposures? For purposes of both HVCRE and HVADC exposures, the exemption for the financing of 1 to 4 family residential properties would include lot or tract development loans. The NPR goes on to state that lot or tract development of condominiums and cooperatives would not qualify for the 1 to 4 family residential properties exemption unless the construction project ultimately contained fewer than 5 individual dwelling units. However, the lot or tract development for row houses or townhomes would qualify for the 1 to 4 family residential properties exemption so long as each unit in the project is separated from other units by a dividing wall that extends from ground to roof. Now, Ben from the OCC will address some of the other previously received questions.
So our next question is there an exemption from HVADC that requires a 15% equity contribution? No. The answer, so the agencies are proposing to not include a contributed capital exemption within the HVADC exposure definition. The agencies considered various means to clarify or modify the contributed capital exemption in a manner consistent with the goals of simplifying the capital rule. However, the agencies viewed the alternative approaches that retained the contributed capital exemption as comparably complex to the existing exemption and inconsistent with the goal of simplifying the capital rule. Our next question is, if we make an interest-only bridge loan to a customer for the purchase of a building, does that meet the definition of an HVADC loan? And if the answer is yes, does that answer change if it is an amortizing loan? Whether a loan is an interest-only or amortizing is not relevant in determining an HVADC exposure. When evaluating a loan to determine if it is HVADC, a bank should first consider whether or not the loan meets the primarily finances or refinances requirement. An interest-only bridge loan to purchase a building would meet the primarily finances requirement as more than 50% of the loan will be used to purchase a building. Next, a bank would determine if the loan meets one of the exemptions from HVADC. With respect to whether or not the bridge loan would qualify as a permanent loan and be exempt from HVADC, the bank should ensure the loan is prudently underwritten and also determine whether the loan has a clearly identified ongoing source of repayment sufficient to service amortizing principal and interest payments aside from the sale of the property. Generally, bridge loans do not qualify for the permanent loan exemption, as the property is not generating sufficient revenue to make amortizing principal and interest payments. Our next question is, would a project to build a community center meet the community development exemption from HVADC? A project to build a community center may meet the community development exemption from HVADC. In order to determine if the community development exemption is met, a banking organization should look to the agency's CRA regulations. If the loan has the primary purpose of community development as defined by the agency's CRA regulations, then the loan would be exempt from HVADC. And I think Matt has another question as well.
Thanks, Ben. I have two questions I'm going to answer. Before I do, I just have to make a note that the views on these questions are staff views and not official positions of the Federal Reserve Board. So a question we received is a non-advanced approaches bank may include minority interest up to 10% of its common equity tier one or total capital, not including the minority interest. Does this mean that cumulatively that the bank may include minority interest up to 30% of its total capital? So no, cumulatively the bank may include a minority interest up to 10% of its total capital, excluding minority interest and after adjustments and deductions. So for example, a parent banking organization, excluding minority interest, has $100 in tier one capital and $150 in total capital. The parent banking organization may include up to $10 of minority interest in tier one capital, but only an additional $5 in its total capital if the banking organization included $10 of minority interest in tier one capital. Therefore, the parent banking organization could include a maximum of $15 of minority interest towards its total capital requirement. Another question we received asks, how does the proposal to extend the transition provisions released by the agencies in August work with this proposal, which includes proposed changes to the treatment of MSAs, DTAs, investments in the capital of unconsolidated financial institutions, and minority interest? So the changes in the transitions NPR, if finalized as is proposed, would apply to non-advanced banking organizations until such time that any changes to the treatment of items subject to transition provisions are finalized and effective. So if any changes to the treatment of items currently subject to transition provisions are finalized, once those changes become effective, any transition provisions applicable to those items would no longer be effective. The intent of the transitions NPR was to help banking organizations by preventing the fully effective requirements of the existing treatment for those items to be implemented by banks. Anticipating this simplifications proposal would propose revisions to the fully phased-in treatment of those items.
And hello, this is David Riley from the FDIC. I've been asked to try to answer some HVADC questions that came in both shortly before the call started and as the call was going on. So the first question I have, actually there's two questions here from a bank or banker. The question deals with the treatment of condominium projects in urban areas where more likely than not the completed projects will look like apartment buildings. The individual units are no less a single-family residence than units built in more rural areas that may look like row houses or townhouses. Why are these apartment building style units not being counted as single-family like the townhouse designs? And it appears the rule discriminates against the individuals who will be purchasing apartment-style residences, as the added capital costs will more likely be passed on to the borrower and then to the end purchasers. So this is a good point that the agencies could consider in reviewing comments to this proposal. So we have a proposed rule, and we're asking bankers and other interested parties and individuals to comment. This is a good question to comment on, and it's also partly addressed in question 3 of the agency's preamble to this AGRIPA NPR. It says the agencies request comment on whether the proposed exemption for 1 to 4 family properties in the HVADC exposure category is clear, such that a banking organization could readily identify which residential loans would be exempt from HVADC exposure? And then what, if any, additional clarifications could facilitate identifying 1 to 4 family properties for this purpose? And then it also says the agencies also solicit comment on all aspects of HVADC exposure category, including the proposed scope and exemptions. So for a question like this, condominium units versus townhouses, recommend that the interested parties actually send a comment to the agencies for us to consider that question formally when we review the comments to this capital rule. And also the question, there's also a comment made, I don't agree with the removal of the required 15% contributed capital on part of the borrower. Do not agree with that. And over my 40-year career as a community banker, I have learned that the more skin in the game the borrower has, the better. So also a very good point to make that that you may want the agencies to consider as we formally review the comments for this rule. So highly recommend that it's an important point that you send a comment into us. And so we also have some other HVADC questions that have come in. If a loan has guarantors with sufficient documented global cash flow that can support a speculative project on an amortizing basis within policy, does the project have to be treated as HVADC? And it also says the project itself would not have sufficient cash flow to support the debt, but the guarantors would. So the general point I would recommend on something like this is that we put out a definition we are hoping is a little bit clearer than the previous HVCRE definition that we were using before, and that we continue to use, that has generated a lot of questions. So if you have any question about whether something is clear or not, we'd recommend a comment about that. Another thing we could formally consider about whether our definition is clear or not. General view in my first impression as someone who works with these kind of loans, but I'm not speaking for the agencies because this is just an initial view. It indicates that guarantors will pay, could pay. It's a speculative project. I think it probably meets the HVADC definition under the proposal, so it probably would be HVADC. But please feel free to comment and to send us comments on that. Another question is, can you clarify whether or not a loan to acquire land to be held for future development or construction of a residential property, residential lots would be considered HVADC, as there is no development going on at this time? So the question is about future development, apparently not current 1 to 4 family development. So again, I'd recommend a comment or question to the agencies about this so we can formally consider it. Initial first impression, similar to our views on HVCRE right now, we try to look toward the call report where it can help provide us some guidance. In some cases it does, in some cases it doesn't. But I think the call report also speaks to this issue a little bit. So future development versus current development, I think that's important. If it's a land intended for future development, that's not necessarily the same thing as an ongoing 1 to 4 family project. So that's a first impression, but recommend you send a comment on that. And the last one I have in front of me, I think actually I have 2 more, excuse me. Can HVCRE grandfathering clause be made optional for firms? This is another thing that recommend you comment about. The proposal as is not optional. It's a mandatory grandfathering, whereas pre-existing loans would be under the HVCRE definition, and loans after the proposed enactment of the proposal, those would be under HVADC. So if you think you want grandfathering optional, recommend you send a comment to the agencies. And the last question I have is in front of me is, if the bank provides financing for a new hotel with a 1-year interest-only period for construction, converting to a 20-year straight amortization of principal and interest, would that be considered HVADC? Note that repayment is not coming from sale of collateral, but rather business revenues generated by the now completed hotel. While it apparently no longer matters, the minimum cash equity of borrower is greater than 15%. So in terms of 15% exemption, if you would like us to consider that, that's an exemption that's in the current HVCRE rule. Recommend you send a comment to us about that. As I mentioned before, question number 3 asks for comment on all aspects of the HVADC. So if the question about the hotel interest-only period for construction, I think that as first impression, that would meet the HVADC definition, at least during the construction stage. Similar to some of the call report guidance, a construction permanent loan after the project's up and running, if you have cash flow for amortizing principal and interest, then that might no longer be HVADC. But that's a first impression. Some of these are project specific, and you have to know the details to really know the whole thing. So at this point, I would like to turn it to one of my colleagues to consider some other questions. So I think Connie Horsley from the Federal Reserve.
Thanks, David. One of the questions that I received was, if a bank has total assets less than $250 billion today, but begins reporting under the HVADC rules and subsequently crests the $250 billion mark, how will it report? So this question has to do with becoming an advanced approaches organization. As proposed, the agencies did not replace the existing HVCRE exposure definition for purposes of the advanced approaches. Under the proposal, a bank that becomes subject to the advanced approaches rule in the future would need to comply with the HVCRE exposure definition in its calculation of advanced approaches risk-based capital ratio calculations. For purposes of its standardized approach risk-based capital ratios, such an organization would be subject to the grandfather provisions for HVCRE exposures originated before the effective date of any final rule, and would be subject to the HVADC exposure definition for loans meeting that definition that are originated on or after the effective date of any final rule. The approach to risk weighting exposures differ across the standardized and the advanced approaches, thus we didn't change it for purposes of the advanced approaches. However, I would note that we did include a question in the preamble. It's question 8 that asks about whether we should consider changing the definition and what, if any, challenges are associated with having a different definition for purposes of the advanced approaches. So we'd appreciate any commentary you have on that, and along with the reasons why we should consider maybe doing something different than the proposal.
So we received another question that says, does the new HVADC definition include a loan whose purpose is only to purchase an office building? So again, our definition is a purpose-based definition, and you would have to look at, is the loan prudently underwritten? And I'd also point out that owner-occupied ADC projects may have sufficient capacity at origination to repay the loan from ongoing operations, in which case the loan would be considered a permanent loan and would not be considered HVADC. I think we have another question.
Yeah, so this is Ben from the FDIC. So we received another question on HVADC, which says, could a construction to permanent loan be moved out of the HVADC category when the construction is complete, the project is stabilized, and the loan has commenced amortizing payments? So based upon initial impressions, the described loan does seem to meet the permanent loan exemption, so long as the loan is prudently underwritten and there is a clearly identified ongoing source of repayment sufficient to service amortizing and principal interest payments, the loan would seem to meet the permanent loan exemption and therefore be moved out of the HVADC exposure category.
So we received another question just asking for clarification on with the loan being interest only, would that necessarily mean that it is HVADC or scoped out? So again, just whether a loan is interest only or amortizing is not relevant in determining an HVADC exposure. You would have to look at, is it a prudently underwritten, and also determine whether the loan has a clearly identified ongoing source of repayment sufficient to service amortizing principal and interest payments aside from the sale of the property.
Okay, and I have another question from a banker. How do we know what bridge loans or repositioning loans are HVADC and which ones are not? So this is another area where I would encourage you to read the proposed definition and read the preamble discussion about HVADC. And if you have a question, recommend you send a comment to us that something may not, whether something is clear or not in your view, or if you have any suggestion how to make it clearer. As my colleagues indicated, the preamble rules indicate, the preamble discussion states the agencies are also clarifying that bridge loans generally would not qualify as permanent loans, as the property is not generating sufficient revenue to make amortizing principal and interest payments. I'd suggest look at that section to determine whether a bridge loan is or is not a permanent loan, and if it's exempt or not. Also, the question goes to, do the rehabs and renovations made to a property treated as HVADC, how are they considered? I would recommend looking at the part of the preamble discussion that talks about the agencies are looking at owner-occupied in the definition, and if the owner-occupier of a property has sufficient capacity at origination to repay a loan from ongoing operations without relying on proceeds from the sale or lease of the property, in that case it might not be HVADC. So you could consider whether the owner has sufficient income from ongoing operations, and also look at that paragraph on about permanent loans. And then the last question, which I'm not 100% clear of the particulars of the situation. For multi-purpose commercial projects, for the acquisition, development, or remodel of income-producing properties count as HVADC. Again, recommend looking at the discussion about permanent loans, about owner-occupied loans, about whether or not there's sufficient ongoing revenue to support an interest principal and interest amortizing payment. Doesn't have to be amortized, but consider if there's income or not to support that, and look at those things in consideration of whether or not a property is HVADC. If you don't think it's clear, recommend you comment on that. At this point, I probably would like to turn to one of my colleagues. Is it Juan Clement from the Federal Reserve wants to give another question?
Yes, so the question is, my question relates to the proposed treatment of investments in the capital of unconsolidated financial institutions. Under the existing rule, non-significant investments in the capital of unconsolidated financial institutions are subject to a 10% deduction threshold, with any amounts exceeding the applicable threshold required to be deducted by applying the corresponding deduction approach, where investments are categorized based on a pro rata allocation methodology, as specified in Section 22 of the rule. Under the proposed rule, investments in the capital of unconsolidated financial institutions are subject to a 25% deduction threshold, with any amounts exceeding the applicable threshold required to be deducted by applying the corresponding deduction approach. However, the proposed rule does not specify an allocation methodology for determining which deducted amounts should be deducted from which tier of capital. So the question is, in scenarios where the total amount of investments in the capital of unconsolidated financial institutions relate to more than one form of capital in the investee institutions, would a pro rata methodology similar to that specified in Section 22 be appropriate to determine the deduction amount allocated to each tier of the investing institution's capital? So The answer to this question is that the proposal does not dictate a specific methodology for the deduction, and basically, comments are welcome regarding potentially a specific approach if the agencies should consider a specific to enforce a specific approach for this deduction approach.
Okay, so we have another HVADC question, which asked us to please restate the proposed 15% capital contribution rule related to an HVADC loan. So to clarify, the agencies are proposing to not include a contributed capital exemption within the HVADC exposure definition. So we propose to remove that 15% requirement from HVADC. The agencies considered various means to clarify or modify the contributed capital exemption in a manner consistent with the goals of simplifying the capital rule. As this exemption was a very large source of questions in the current capital rule. But in the agency's view, the alternative approaches that retained the contributed capital exemption are comparably complex to the existing exemption and therefore inconsistent with the goal of simplifying the capital rule. So from the proposal's perspective, we have excluded, we have not included this exemption.
I have another HVADC question that just came in. Please explain if a loan for the acquisition purchase of a commercial building is an ADC loan if the borrower's intent is to resell the building as the source of repayment of the loan. I can only give first impression because we don't have the all the particulars, but first impression would be it's probably HVADC because it sounds like the repayment is from the resale of the loan. I'd again recommend, as with other questions, looking at our discussion in the proposed rule about permanent loan, about owner-occupied loan, about multi-purpose. Look at those things, and if there's a question after reading those, recommend a comment to ask us to clarify, and we'll consider that as part of our formal comment review process. Are there other questions coming in? In that case, Ben, I'll turn it to you to close if no other questions are coming in.
Okay. Well, we just want to thank everyone for their participation today. Thank everyone for all of the questions that we received. We look forward to receiving all of your comment letters and also looking at all these questions we've received today, including the ones that we haven't been able to get to and to answer. And as always, you have our contact information, so as questions arise, please feel free to contact us. Thank you again. Good afternoon.
This concludes your conference, and you may disconnect. Once again, your conference has ended, and you may disconnect. Thank you for joining.